Guys, I know you have heard video after video telling you to invest in the S&P 500 and how it's going to be one of your best investments, but I have something to tell you. Somebody is lying, all right? And no, it's not your favorite YouTube finance guru. It is yourself, the people who don't invest because of the fear of the unknown and the risk that the S&P 500 could fall. But guys, the true risk of the S&P 500 is that while you're waiting on the outline, on the sideline, people are going to get rich because they're... Now guys, cash depreciates because of inflation. Now inflation is actually, believe it or not, something that's needed in an economy to keep it growing. And I can go over that in a separate video on why that is. But today, what you guys have to understand is that while you're holding cash, the price, look at the chart, the price falls down on the value that cash can buy, which means $10 worth of groceries today is going to be very different than $10 worth of groceries in 10 years from now. It's going to be drastically different. Now, how can you avoid this problem? Because that means if you just keep saving your money is just inflating and you're just going to be able to keep buying less and less until all the money you get is very much meaningless. Well, guess what? As cash has fallen down 90%, as you can see, from not that long ago, index funds have grown the complete opposite. Every 5 to 7 years, they're doubling in price. So you would be more than making your money back if you had just invested in the S&P 500. So guys, I'm not telling you that you need to invest in the S&P 500, but I am strongly encouraging it because if you take a look when you're holding cash, even in GICs, I know a lot of people like guaranteed indexes where they're going to make some money out of it, or guaranteed interest, my apologies. So I know people like guaranteed interest because they're going to make a certain amount of money, or holding CDs or whatever you like. But guys, you have to understand the return you're getting is a lot smaller. Now, if you're older and you need this cash in the next 5 years and you can't handle a downturn, of course, then CDs, all this information is very good for you. And buying GICs is very good for you. But if you know that this money, you can long it for a very long period of time and you don't need to touch it, guys, invest it. What are you doing? Understand, this cash is going to keep depreciating while your assets will keep appreciating. All right. And guys, believe it or not, when you're buying indexes, you're buying asset. You can borrow from these assets. They're just like that. Now, I'm not telling you to, but I'm just explaining to you that while your cash makes you poorer, your assets make you richer. And the true people who in every economy, the downturns, the upturns, the people who made the money are not the people who are living off their paycheck to paycheck or saving a little bit of money. They're the people who are consistently investing into assets. Doesn't mean you need to hold 100% of your securities in your house because that's a bad investment. But that does mean that you should be diversified with stocks, with other parts of the economy, with houses, with whatever you can. And that can be your own personal house, your own personal residence. But guys, at the end of the day, assets are assets. And if you buy assets, you're going to be rewarded. Thanks for tuning into this short video.